Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. Nothing new. Success still depends on mastering your emotions, not the latest trends. A colleague who tracks technology pointed me to this tweet some time back. You can become a cracked dev without following all the tech news daily. The fundamentals barely changed in 30 years. You are not missing anything. The parallels with investing are clear and quite instructive. Superficially, a great deal has changed in investing over the last 20 to 30 years. All processes are digital and online. Money can flow from your bank accounts to your investments and back instantly. There is an enormous amount of information available at our fingertips. New investment products appear regularly, each promising to revolutionize how we build wealth. Social media serves up a constant stream of market commentary, tips, and predictions. Yet, despite all this apparent transformation, the determinants of investing success remain the same, and most of them are inside your head and your heart. Basic emotions like fear, greed, and impatience are still where you will either become wealthy or fail trying. Consider what hasn't changed. Markets still go up and down in unpredictable patterns. Companies still succeed or fail based on how well they serve their customers. The power of compounding still rewards those who start early and stay patient. And most importantly, the majority of investors still make the same fundamental mistakes that have plagued savers for generations. The technology revolution has made investing more accessible, but it hasn't made it easier. If anything, the constant noise has made good investing harder. When information was scarce and expensive, investors were forced to think more carefully about their decisions. Today, with free access to real-time data, research reports, and expert opinions, many investors suffer from analysis paralysis or, worse, are driven to make hasty decisions based on the latest headline. The abundance of choice has created its own problems. 30 years ago, an investor might choose between a handful of stocks or mutual funds or deposit schemes. Today, there are thousands of funds, dozens of asset classes, and countless strategies to choose from. Yet, this explosion of options hasn't led to better outcomes for most investors. Instead, it has created confusion and encouraged the kind of complexity that successful investing abhors. What the fundamentals tell us is that good investing remains stubbornly simple. Spend less than you earn. Start early. Diversify sensibly. Keep costs low. Stay patient during market turbulence. These principles were effective in 1995, they remain effective today, and are likely to continue being effective in 2055 as well. The real challenge isn't keeping up with the latest market trends or investment products. It's staying ahead of them. It's mastering your behavior. The investor who can remain calm during a market crash, who doesn't chase last year's best performing fund, and who doesn't panic when headlines scream doom, this investor will succeed regardless of technological changes or market innovations. The tweet about technology development contains another important insight. You're not missing anything. In investing, this fear of missing out drives countless poor decisions. Investors abandon sensible long-term strategies to chase whatever is performing well today. They convince themselves that they need to adapt to new market conditions. But the fundamentals suggest otherwise. The investor who missed the dot-com boom also missed the dot-com crash. The investor who avoided cryptocurrencies missed both the spectacular gains and the devastating losses. Often, missing out on the latest trend isn't a failure. It's prudent risk management. This doesn't mean you should ignore all changes in the investment landscape. New products, such as ETFs, have genuinely improved options for retail investors. Digital platforms have reduced costs and improved access, but these are tools that help you implement timeless principles more effectively, not reasons to abandon those principles. The next time you feel pressure to change your investment approach because of some new trend or market development, remember that programmer's wisdom. The fundamentals haven't changed in 30 years. Focus on mastering those, and you're unlikely to miss anything that truly matters. Your future self will thank you for the discipline you show.